So before we get started, check out the following links in the description box below as highlighted in the image shown. So you'll be able to get our past papers, our link to our official website, link to accreditations, our link to donation page, and contact details in the description. So once you'll be watching a certain video of any lesson or of any past paper, you'll be able to get all these links, and you can be able to get to download past papers, to reach to our official website. You'll be able to see links to our accreditations so that you can see which authorities have accredited us. You'll be able to reach to our donation page as well as our contact details.
So welcome class again, and we're going to tackle question number 4. Question number 4. It's a cash flow question. The following are the financial statements of HMK Limited as at 31st December 2022 and 2023. This is very important for our cash flow because of comparisons. So you can see ordinary share capital increased from 600 to 900, share premium from 90 to 210, revenue reserves 84 to 246, total equity and reserves. Debentures reduced from 300 to 180, bank loan from 120 to 0, means they were paid. Trade payables, these are an increment. Proposed dividends, an increment. Corporate tax, you can see it's an increment. Bank overdraft, it's a reduction. Freehold land, an increment. Plant and machinery, an increment. Furniture and fittings, an increment. And remember, cash flow is just about the flow of money, movement of flow. That's all we want to capture. Because if it's an increment or a reduction, that's all. So inventory 222 to 306, an increment. Trade receivables, an increment. And if it increases, it means more money has been spent. Like, more money has been spent, literally. That's what it means in inventory. Because inventory you have to buy using cash. Cash in hand, there we go. So additional information, a machinery with a net book value of 12 million, original cost was 48 million, was sold for 18 million. Furniture with a net book value of 18 million, original cost 30 million, was sold for 13 million. Profits and losses on these transactions had been reported in the statement of profit or loss. Corporate tax for the year ended that was 80 million. The proposed dividends for the year ended that were paid during the year ended that. There was no disposal or revaluation of freehold property in the year ended that. Interest expense charged to the statement of profit or loss for the year ended that was 38,400. Accrued interest 26,400 is included in trade payables. Depreciation charged to the statement was furniture 34 million, plant and machinery 58 million. So what are required? Statement of cash flow for the year ended 31st Dec 2023, in accordance with IAS 7. Statement of cash flow. So they just require, the question requires us to do a statement of cash flows. For this company, the company is referred to as HMK Limited. So we'll have HMK Limited. HMK Limited, statement of cash flow. Statement of cash flow. Statement of cash flow for the year ended 31st December 2023. For the year ended 31st December 2023. For the year ended 31st Dec 2023. So there we go. We always start with the profit before tax, and I will say cash flow from operating activities. Normally we have 3: cash flow from operating, investing activities, and financing activities. Those are the three areas. Cash flow from operating activities, investing activities, financing activities. So cash flow from operating activities, we start with that, and we start with the net profit before tax. Net profit before tax. So we simply look for our net profit before tax. Preferably we need to have two columns. So net profit before tax, you simply go. Have we been given net profit before tax? I think we must have not been given. We don't have. So our savior will be here. We'll have to find, because normally net profit before tax is given in the P&L account. It's in the P&L account. That's why we get net profit before tax. But since we have not been given the P&L account, it's very clear we've not been given. And even in the additional information, they are not saying anything. They're just talking about corporate tax. You can see corporate tax here. Post dividends, they're not saying anything about net profit. Nothing about net profit. So the only alternative we have is here. So we have to get our net profit from here. So ordinary, of course, this is capital. This one now has everything to do with capital. Revenue reserves, total equity. So under revenue reserves, that's where possibly we can start from and get our net profit from. Because in the previous year, revenue reserve, these are now, the profits, net profit will definitely come here. So you can see there was an increment from 84 to 246. There was an increment from 84 to 246. So most likely that increment is what will form part of the net profit for this financial year. So let's just do something here. So we can say revenue reserve for 2023 is 246,000. Then revenue reserve for 2022 is 84,000. So this means that the increment is 246 minus 84. That gives us 162,000. 162,000. That could be our net profit. But let's see if there's any dividend that was distributed, and because we also talk about it's supposed to be net profit before tax, so and taxes. And taxes, I think we were told here, the proposed dividends for the year ended at 1st December 2022 were paid during the year ended at 1st December 2023. Yeah. So what was the proposed dividend for the year ended at 1st December 2022? Proposed dividend for the year ended at 1st December 2022. But remember, they are saying that what was proposed for the year ended at 2022 was paid in 2023. So this should be the figure. What was paid in 2023, it's 90,000. So this was declared in 2022, but was paid in 2023. That is what the statement tells us. That the proposed dividend for the ended at first DEC 2022 were paid during the ended at first DEC 2023. So that dividend, the proposed dividend of 90,000, means that it is part of the profit of the previous year. Then let's also get this. There's something about this one doesn't apply because it's purely for this year, so we leave it. Okay, corporate tax for the year ended at first DEC was 80 million. So I think those are the two items. So we'll simply come here and say dividend for the year for 2022 that was paid this year is 90,000. and then we add also the corporate tax, because what we normally work with is net profit before taxation, so we need to get taxation back. So this will be 162 plus 90 plus 80. That gives us 332,000. So this will be our net profit before tax, and you can call this working one. So let's just come back here and say net profit before tax. This will be 332,000. Then once we are done with that, now the rest will now flow. I hope the rest will now flow. It should be very easy now. We simply go to add back depreciation. We add back depreciation. So we always talk of add back depreciation. So depreciation, I think we've been given depreciation in this question. So furniture and fittings, 34,000, they are here. So furniture and fittings, 34,000. Then plant and machinery, 58,000. Yep. So we add back those two, and then if we have a loss, losses are also added back. Losses are added back. So then gains are deducted. Why are we deducting gains? And normally the depreciation and the interest expenses are supposed to be added back to the operational account. Then we'll remove interest expense later. In fact, we're going to meet here interest expense. It's number 5. So those ones it's just like that. You don't have to think about them. When you get a depreciation, add them back. It's as simple as that. That 4,000, 58,000. Then let's find out if there is any loss or gain in sale of any asset. So a machinery with a net book value of 12. This is also straightforward. Just pick it from here. 12 million original cost was 48 million. We are not interested in that. Was sold for 18 million. So what is this? Its net book value is 12 million, but it was sold at 18 million. So this is a gain of 6 million. So simply come here and say gain on sale of, what is it that was sold? Gain on sale of machinery. Gain on sale of machinery. How much was the gain? 6,000. We less the gain. And the next we have another item here. Furniture with a net book value of 18 million was sold for 13 million. So it was supposed to, the book value was 18 million, but it was sold for 13 million. So it's a loss of 5 million. So we say loss on sale of furniture. Loss on sale of furniture. It's 5 million. And that is 18 million minus 13 million. Just like that, you get 5 million. Sale of furniture. So it's 18 million minus 3 million. Okay. So I think we are progressing on well. The next thing is, remember I told you interest. Anytime you find interest expense and there's something else. Interest expense and let me just show you what we're talking about. Interest expense and so interest expense and dividend income. Interest expense and dividend income. Those ones you see, you need to. Interest expense and dividend income. Those are, they belong to the same group and same treatment will be accorded on them. Interest expense and dividend income. Just a minute. So we need to add back that interest expense. It's called it's a finance cost, so we will feature it in the financing cost. This one is operational. Remember, we've started cash flow from operating activities, so when we come to financing activities, we'll include it again, but for now we had removed, so we add it back. So what are we going to say? We simply say finance cost, or we say interest expense, but let's just say finance cost, or interest expense. This will be 38,400, like that. I think the figure is correct. Let me hope the figure is correct. 38,400. Good. Accrued interest, no, that one doesn't apply because it was included in trade payables. That one doesn't apply. Okay, so 38,400. Anything else? We don't have anything else remaining, so we immediately go to the changes in working capital. Changes in working capital. And in working capital, we are going to compare inventory. And inventory, you can see there's an increase. An increase in inventory simply means that money has gone out. So just get the inventory in the current year minus the preceding year. So in our case, it will be 306 minus 222. This one, 306,000 minus 222. 306,000 minus 222,000. That is what we are talking about. That is the change, and that change is what we are interested in. So we'll simply say increase in inventory. 84,000. Increase in inventory, how much? 84,000. And because it's an increase in inventory, it means money left the organization because we spent so much. That's why we have extra inventory. So this will be in brackets, so that money has left the organization. Then we go to who is this? The next item here, trade receivables. You can also see this is an increment also. Actually, increments in current assets will mean that money has been spent. So we are going to put them in brackets to show that there's a cash outflow. So 264 minus 256.8. That gives us 7.2. So increase in trade receivables, 7.2. Increase in trade receivables. Increase in trade receivables, 7.2. And because it's an increase, so we are going to put it in brackets. Then if it was a decrease, we will not put them in bracket to show that money has come in, an inflow. That's how basically it goes. Then the next item is we have short-term investment. No, that is cash related, so that one we don't capture it. Actually, we shall capture it in the end to justify if we have gotten it right. So this part of it's part of cash generally. Short-term investments, they can easily be liquidated. So we'll leave it at that. So I think we are done with the current assets. Let's go to current liabilities. Trade payables, we have trade payables here. So trade payables, there's also an increase from 204 to 288. Hope you are seeing that, 204 to 288. So what we are going to do is 288 minus 204. What do we get? 84. So this is also 84,000 is the change. But there is some working here, 84,000. Remember, there was something that was included here. I remember there was something that was included there. Sorry, moving right back. There was something that was included here. Interest expense charged to the statement of P&L was 38,400. Accrued interest of 26.4 is included in trade payables. Accrued interest definitely not supposed to be included here. So we'll say 84,000 minus 26,400. To remove that accrued interest. Accrued interest is not part of trade payables. So it's a liability, yes. A current liability, yes, but not trade payable. They're different things. So 84,000 minus 26,400. This gives us 57.6, 57,600. 57,600. But this one is an increase. An increase means that we are saving. We've not paid so much money, so it will go as a positive. So we'll say increase in trade payables. Otherwise, if it was a decrease, I hope you are getting the increase and decrease. These are trade payable. We are supposed to be releasing money, and so if we have not released, it's a better thing for us. It means we have okay. So having said that, the next item is let's go back again and check our liabilities, current liabilities. So trade payables, we are done. Proposed dividends, this one will capture in under the financing. Under the financing, that's when we'll talk about proposed dividends. Corporate tax, bank overdraft. Bank overdraft will be captured with the cash, will be treated similar with the cash. So corporate tax, yeah, corporate tax, we need to talk about corporate tax. We need to talk about corporate tax. So at the beginning, this one will have to have some workings here. At the beginning, corporate tax account. Corporate tax account. So at the beginning, balance brought down. At the beginning, we had how much? I think I'm now getting tired. So, because corporate tax, I've started from this side, definitely. Balance brought down on the credit side because it's always a credit balance. So where is it? Where is it? Where is it? Corporate tax 129,000. So 129,000. And then what happened? 129. Closing balance, definitely. Balance carried down. We're talking about 198, what we have there. And then there's an amount which was paid by, how much was it? Corporate tax for the ended that first was 80,000. So of course this one will be credited here. It increases our liability. So corporation tax, this is 80. Yeah. We started with this. Then for that year, 2023, the year ended 2023, this was a new liability. So total liability was 129 plus 80. This gives us 209. And here also 209. And then what we started with the following year was 198. So it means what we paid was 209 minus 198. And remember, we are finding out what has been paid, the cash movement. So this is what has been paid, and this will be bank account. So our bank account has paid 11,000. I'm restricting the zeros here, but this is essentially what happened. We started with 129, another added liability of 80 for that year. Then we closed the year with 198. This means that we paid 11 because the total liability was 209, but we closed the year with 198. So how much have we paid during that year? It's 11. This is the cash movement, the 11,000. It means that that's the tax that we paid during that year. So we simply come here and say 11,000. And since this amount was paid, it will definitely be, it left the organization. So we'll talk of 11,000 as being tax paid. Tax paid, 11,000. And it's that the reason that I've given you. So then we can work out all this, and all these are operating activities. I doubt if we have any other item remaining, so we'll simply say net cash flow from operating activities, then add all of them to get the total. So this will be 34,000 plus 58,000 minus 6,000 plus 5,000 plus 38,400 minus 84,000 minus 7,200 plus 57,600 minus 11,000. So 84,800. That will be the figure that I have. 84,800. 84,800. Might want to counter check that. 84,800. You might want to counter check that. You might want to counter check that, but for now let's proceed. So then we go to cash flow from investing activities. Cash flow from investing activities. Cash flow from investing activities. That is the second part. Remember, we said we have three parts. So the first one was cash flow from operating activities. We've gotten the answer. Cash flow from investing activities. That's where we are. So let's pick cash flow from investing activities. And we start with the obvious ones. Whenever we have proceeds, that is money coming in. And it's very clear there are some proceeds here. So proceeds from sale of machinery. We sold machinery. So proceeds, sale of machinery. How much is that? I think it was, the figure was 18,000. And then we also had proceeds from sale of furniture. And the figure was 13,000. So those are very straightforward cases because they can be gotten from here. 18,000 and 13,000. Remember, in the first part we were just dealing with gains or losses, but here these are intangibles. But here now we are money came in, so that money that comes in we have to capture. Then let's go back to the asset account and see freehold land. You can see there's something here. It was 780 and now it is valued, it was 660, but now it's valued at 780. So there's an increment of 120,000. 120. But we've also been warned that the 120 is not a result of, there was no disposal or revaluation of freehold property. So it means chances are very high, because there's no revaluation, there's no disposal, chances are very high that this is an acquisition. Because initially our land was valued at 660, now it's valued at 780, and there's no revaluation. So chances are very high that we have spent some 120,000 shillings to acquire more land. And since we have spent 120,000, that involved an outflow of money. Money went out. So we simply come here and say freehold land, 120,000. This money went out. The first two money came in. This one, money is going out. So that's how we go about it. You just say freehold land, 120,000. Then the next item is plant and machinery. It was 450, now 582. But remember, there's quite a lot under plant and machinery. Perhaps we need to have an account here, plant and machinery account. Opening balance, this is balance brought down because it's asset is a debit account. Plant and machinery is an asset, it's a debit account. So 450 will definitely be here. And then then we have original cost 48 million. We just captured the we sold it. So bank account, plant and machinery. Yeah, bank account received 18 million. That's where our concern is. And then the depreciation was depreciation for plant and machinery is 58 million. And then what else? Depreciation 58 million. Then we closed the year with 58. We closed the year with 58,582,000 plant and machinery net book value. So plant and machinery balance carried down will be 582,000 as per the question. So then the figure that we get there will mean that that is the cash that was, yeah. So this will be 582 plus 58 plus 18. That gives us 658 as our balancing figure. 658 also this side as our balancing figure. So 658 minus 450, that gives us 208. So 208, this is a bank account. We'll say that this is the amount of money that left the bank account, because it makes a lot of sense. We started the year with 450. We sold some asset, but we closed the year with 582 worth of plant and machinery asset. So there must be some amount that bank has spent, and we have just found out that the amount in question is 200 and is it 200 and, is this correct? 18 plus 58 plus 582. 18 plus 58 plus 582. That gives us 658. It's just correct. There's something I'm missing. We are not supposed to, it's not 12, it's bank account. No, it is the value of the, sorry. This is not supposed to be like this. It's supposed to be the value of this item. So we'll talk of the disposal account. It's actually supposed to come from the disposal account, and we are talking about 12,000. That is the value of the asset. Sorry, so this is supposed to be 652. 652. If you add these figures, you get 652. That is 12 plus 58 plus 582. So this side also will be 652. 652. So this will be 202. 202. That is the amount that will have left the bank account. So 202. You need to be very keen. You can see simple mistakes can cost you. So plant and machinery, we're talking about 202. That's an amount that left the bank. That's why we have the additional plant and machinery asset that we have seen in the question. Furniture and fittings, almost the same case. 84 minus 66. What do we have? 84 minus 66. But we also need an account for furniture and fittings, because it's the same case. Furniture and fittings account. So balance brought down how much? It was 66,000. 66. Let's just have it like that. 66. And then disposal account disposal account, we'll have now in this case 18,000. That's what I was confusing with, 18,000. And then we have depreciation for furniture. I think the figure was 34,000, but let's be very sure to avoid again further confusion. So depreciation 34,000, and then we have what we closed the year with, balance carried down. How much? 84,000. So then let's get the total. Whatever the balance, this will be a bank account. So this is 84 plus 34 plus 18. That gives us, let me repeat, 84 plus 34 plus 18. This is 136. So 136 minus 66. That gives us 70. So 70 is what the extra amount that was spent from the bank. And because this was spent, you can see the increase in furniture. So it means that money went out in excess. Of course, we received some amount in when we sold the furniture, but what went out to purchase more furniture was higher than what we received, and so it cancelled the effect of receiving. So furniture and fittings, 70,000, like that. Like that. So I think we are on the same page. Do we have any other asset that is remaining for investing activities? Now you can see these are real investments that we are talking about here. So we don't have any other non-current asset that is remaining. So we can simply add this and get the total, then leave this place. So we simply say net cash flow from investing activities. I hope you like my handwriting. It's one of the best. It was voted as being one of the best handwritings around. So 18,000, 18 plus 13 minus 120 minus 202 minus 70. What do we get? 361,000, and this is a negative. So then we go to cash flow from financing activities, which is the last part. Cash flow from financing activities, which is the last part. Okay, so from financing activities, we are going to put camp in the where here, ordinary share capital. You can already see there's something here. So issue of share premium, issue of ordinary share, issue of share premium, issue of ordinary share, revenue reserve we've already captured. So we'll start with the ordinary share capital. You can see the increment is 300,000. It's very clear, 300,000. So ordinary share capital 300,000. Simply come here and say ordinary share capital 300,000. Are we losing or we are gaining? This is money that is coming in. Ordinary share capital, money is increasing, so it's money that we are receiving. So it's a positive figure. It's an inflow. And then we got the next one, share premium, 210 minus 90. We started 90, now we have 210. There's an additional 120,000. So share premium 120,000. Simply come here. Share premium 120,000. Then the third item is we go to total revenue reserve, total equity. Okay, let's look at the debentures. Debentures, we started 300, now we have 180. It means we paid 120. The difference is 120, and it means that we reduced our debentures a loan, so we reduced our loans by 120. And reducing our loan means that it's an outflow, money went out. So debentures 120,000. Debenture 120,000. We'll go back again. Hope you are enjoying. This thing is not that hard. If you relax and enjoy. So debenture 120,000. Bank loan, bank loan also. It was 120, now it's 0. It means we paid loan to the extent of 120. That's an outflow, money went out. So bank loan 120,000. Bank loan 120,000. Bank loan 120,000. Oh, I'm supposed to put this in brackets because this is money going out. Those two money going out. Ordinary share premium money was coming in. So we are good to go. The next thing is let's pick what is next. Debenture we are done. Bank loan we are done. Long-term liability, I think we are done. We are done. There's something that we removed from the operational income, you remember, from the operational activities. This one, interest expense, and we said we are adding back there. So this is the right place where we are supposed to capture it and remove it. So we'll simply say interest expense. But remember, they also accrued. This accrued is accrued interest, which was wrongfully added in trade payable. So we are going to consider it here. So we'll simply say interest expense. It was the figure is 36,400, but the one that was wrongfully accrued was, I'm not so sure these figures. That 8,400, 26,400. That 8,400 minus 24,600. I guess that's how it is. That 8,400, 24,600, is it? 26,400. That 8,400, 26,400. The error of transposition 26,400. That was almost an error of transposition. So that 8,400 minus 26,400. This gives us 12,000. So 12,000. And this one, you remember we added back. So this is the right place. So we are just supposed to remove it because it's an expense anyway, but it's a finance expense. So in the operational, we add it back because it doesn't fit there. So this is where it features. So we are supposed to just deduct it or remove it. But no, this is something that had been erroneously put in under trade payables. So the whole thing is we deduct. Now, what else is remaining? I think we should be winding up. We should be winding up. So yes, we are done. And so we close the, wait a minute, there's this something, the proposed dividends for the year ended that was paid. Proposed dividend, there's something about dividend because dividends is also a finance related cost. So dividend, proposed dividend, yes, you can see it's here, from 45 to 90. The previous year we paid 45, this year we paid 90, so there's an increment of 45. So proposed dividend 45,000 left the organization in excess. So proposed dividend, we're almost forgetting this, proposed dividend 45. And I hope you are seeing it's just a comparing, and this is money left the organization, so it's definitely on the negative. So having added that, I think we are good to go. So you can again say net cash flows from financing activities. This will now be 300 plus 120 minus 120 minus 120 minus 12 minus 45. That gives you 123,000, and it's a negative 123,000, which is a negative. So we add all this, and this thing is just done like this. Even in a practical audit, it's the same stuff. 332,000 plus 84,800 plus, minus 361,000 minus 123,000. That gives us 67,200. 67,200. 67,200. Will this be right? 300, 120. This is 420 minus 120, 300 minus 120, 180. 180 minus 12, 168, 168 minus 45. That is 123, 123,000, but a positive. See, I like making this kind of mistake so that you can also see that sometimes you fail not because you don't know, but because you are in a hurry, or you are tired, or you are absent-minded. So see what we had gotten just carelessly. So let's repeat that. But it's always good to allow your subconscious mind to be following up what you are doing. If you add, follow it up subconsciously, so that sometimes the inner person might be telling you, can you repeat that? If you feel that you need to repeat some calculation, kindly go ahead and repeat. 178,800. I hope we are gotten it right. Let me just assume we've gotten it right. So 178,800. So then what we need to do is to add the cash at the beginning. So we say cash and cash equivalent at the beginning, cash and cash equivalent at the beginning. We add here, and cash, no, just like that. We'll add cash and cash equivalent at the beginning. So at the beginning, what was cash and cash equivalent? We are done. So we are now reconciling the two books. At the beginning, our cash was short-term investments, 0. Cash in hand, 1,200. Overdraft. Please, those three will always form part of the cash in most cases. So you can see overdraft is 84,000 and cash in hand 1,200. So what that means is we have 1,200 minus 84,000. Overdraft is a negative figure. So this is 82,800 negative. Means we had overspent. We started with a negative balance. So cash at the beginning is 82,800 negative. We add here. So 82,800 plus 178,800. What do we get? 96,000. So this becomes cash and cash equivalent at the end of the year. So can we go back and check if indeed that is the cash and cash equivalent at the end of the year? The good thing with the cash flow statement is that by the time you're done, you know whether you passed or not. The test is always has an answer. So short-term investment, you can see short-term investment is 27,600. It's part of the cash and cash equivalent. Plus, let's see, cash in hand, 68,400 and 6,000. So we are done. 27,600 plus 68. This plus this. All these are cash and cash equivalent. 27,600 plus 68,400 is 96,000, which is what we have at the end. So this is what we had at the beginning, this is what we had at the end, and this is the increase in cash and cash equivalent for the period. Increase in cash and cash equivalent for the period. It's an increase, you can see it's an increase. Otherwise, if it will be a negative, we will be talking about a decrease in cash and cash equivalent for the period. So that is the end of that question. It was a good question, good for practice. Please do quite a number of this. This is a question that you should not allow it just to go like that. It's a good question that you definitely need to do in an exam. Yeah, we are done. Remember to join us in our classes, www.globalpointlearningcenter.com. Enroll for our classes. You'll meet this staff. We have classes on this. You can attend the classes even at midnight at your own pleasure. Forget about these things of going to class up to 5, you are tired, you go sleep in class. Go back home, refresh, relax, eat, play with your kids, and when you are relaxed, or midnight, or very early in the morning, when you are fresh, you can wake up, log into our system, and attend classes. The lecturer is there teaching you at your own convenience. Welcome, and thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions, and also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.